Hello, and welcome to the February IASB Update podcast. I am Nili Shah, the Executive Technical Director at the IASB, and I'm here today with Andreas Barckow, Chair of the IASB, and Linda Mezon-Hutter, Vice Chair of the IASB. Welcome both.
Thanks, Nili.
Thanks, Nili. Glad to be here.
Thank you. This month, the IASB's agenda was packed with many interesting topics, as we discussed a number of these topics and made a few milestone decisions. So let's dive straight into it. We'll start off with maintenance projects. As many of you are aware, our maintenance projects differ from our larger research and standard setting projects in that they're narrow scope projects typically to improve the consistent application of a standard and to maintain a standard, as the name would suggest. One of the projects discussed this month was the Supplier Financing Arrangements project, which proposes amendments to IAS 7, Statement of Cash Flows, and IFRS 7, Financial Instruments Disclosures, to help users understand the effects of such arrangements. Andreas, can I hand over to you for some updates to this project?
Certainly. Thanks, Nili. So to our listeners, if you follow this project closely, you will remember that last month, the IASB discussed whether its proposed amendments related to supplier finance arrangements should be made effective in 2024 or 2025, as the staff had proposed. The IASB has asked the staff for more information before making a decision, noting the lack of transparency about these arrangements and some recent corporate failures, balanced with the need for jurisdictions to have sufficient time to endorse the amendments and for preparers to collect the necessary information. This month, the IASB decided that companies will be required to apply the amendments for annual periods beginning on or after 1st of January 2024. So we actually pulled the effective date forward by 1 year. The IASB also made accommodations for disclosures about comparative information, interim period disclosures, and selected quantitative information disclosures within the annual reporting period a company first applies the amendments to ease their transition burdens. We are now working on drafting and balloting the final amendments with a plan to issue them in May.
Thank you, Andreas. So also within the maintenance workstream, the IASB discussed the lack of exchangeability project, which proposes amendments to IAS 21, our standard on the effects of changes to foreign exchange rates. The amendments would help companies determine whether a currency is exchangeable into another currency and the exchange rate to use when it is not. Like the supplier finance project that Andreas just discussed, on this project, the IASB also decided on an effective date, in this case, 1 January 2025. And next, the IASB will begin drafting and balloting the final amendments with a plan to issue them in Q3 of this year. Finally, as part of our maintenance work, the IASB discussed the first batch of proposals for its next annual improvement cycle. Linda, could you share more about what annual improvements are?
Well, I'm happy to do that, Nili. Thanks very much. Annual improvements refer to a collection of proposed amendments to IFRS accounting standards that are minor or narrow in scope, which we will then package together and publish together in a single exposure draft. Now, this isn't exactly the best name because we don't always do these exposure drafts annually. Rather, we wait until we have a collection of minor amendments. This month, the IASB discussed potential clarification and amendments to our standards on financial instruments, consolidated financial statements, statement of cash flow, and a few others. This discussion followed an in-depth discussion by our Interpretations Committee at its November 2022 meeting. The Interpretations Committee discussions were very helpful in informing the board's decisions on these items. The IASB is expecting to discuss more of its potential annual improvements in the coming months, so please do keep an eye out for this.
Thanks, Linda. So moving on from maintenance projects, let's go on to post-implementation reviews, or PIRs. As a reminder, we do PIRs on new IFRS accounting standards after they have been applied in practice for at least 2 years. The objective of a PIR is to assess whether the accounting standard is working as intended when the IASB issued those new requirements. Now, as some of you may already know, the IASB's post-implementation review on IFRS 9 is split into 3 parts. In December 2022, we concluded the first part on classification and measurement, and we also have the PIR on hedging upcoming in our pipeline. At the moment, the IASB is working on the PIR of the impairment requirements in IFRS 9. So that's the expected credit losses requirements, or ECL for short. Andreas, could you highlight some of the key takeaways from the IASB's discussion this month?
Sure, Nili. In this month's meeting, we discussed feedback from stakeholders on their experience of applying our ECL requirements and credit risk disclosure requirements in IFRS 7. Since September last year, the IASB members and staff have done approximately 30 meetings with stakeholders around the world and have gathered helpful information to inform this PIR. We truly appreciate all the time and effort from our stakeholders. We also discussed the review of academic literature relevant to the PIR, summarizing academic research findings from over 20 academic papers. Considering stakeholders' feedback, the IASB was able to identify and decide on topics for which it will consult publicly on in an upcoming request for information. This consultation will seek stakeholders' views on topics such as the application of judgment in determining significant increases in credit risk, the use of multiple forward-looking scenarios and the use of post-model adjustments or overlays when measuring ECL, comparability of information resulting from applying the objective-based credit risk disclosure requirements, and a few other topics, including the simplified approach and the interaction between the ECL requirements and the other requirements in our standards. The IASB is expecting to publish the request for information by the end of May 2023, so please do keep this project on your radar.
Thank you, Andreas. So let's move on to our standard setting projects. This month we discussed 4 of them, and we'll start off with our Financial Instruments with Characteristics of Equity project, or as we like to call it, FICE. This project looks at addressing common accounting challenges that arise in practice when applying our accounting standard for presentation of financial instruments, IAS 32. Linda, could you let us know more about how the IASB's discussions went this past month?
Of course, Nili, happy to do that. So this month we discussed what we call sweep issues. And sweep issues are issues that come about as a result of discussions we've had throughout the commentary on an item. And we want to make sure we're all very clear on exactly what we've decided, or we have to redeliberate something that wasn't quite clear. So this month we discussed sweep issues relating to classification and presentation that arose following the IASB's discussions and tentative decisions in the past 2.5 years. So for example, we considered topics like the famous fixed for fixed condition, reclassification, the effects of laws on the contractual terms, obligations to redeem own equity instruments, and the presentation of financial liabilities containing contractual obligations to pay amounts based on a company's performance or changes in net assets. So if you're more interested in any of these items and you want more detail, please refer to the IASB update on our website.
Thanks, Linda. Do keep a close out for developments on this project as the IASB is nearing the end of its deliberations, and its plan is to publish an exposure draft of its proposals towards the end of the second half of 2023. So with that, let's move on to our second standard setting project that we discussed this month, which is rate regulated activities. As some of you may be aware, the IASB is working on a new model to account for regulatory assets and regulatory liabilities. This means if the IASB were to go ahead with this project, the IASB would issue a new IFRS accounting standard that would replace IFRS 14, regulatory deferral accounts. This month, the IASB continued redeliberating the proposals in its exposure draft, focusing on 2 topics, recognition and performance incentives, except for long-term performance incentives, which will be discussed at a future meeting. Andreas, could you start us off with the IASB's discussion on recognition?
Sure, happy to, Nili. The 2 aspects of recognition discussed are the proposed threshold for the recognition of regulatory assets and regulatory liabilities, and its interaction with the assessment of enforceability. So with the proposed threshold for the recognition of regulatory assets and regulatory liabilities, the question we are really trying to answer is whether we should preserve the proposed recognition threshold that is based on only existence uncertainty. This month, the IASB decided to retain the proposal that a company should recognize a regulatory asset or a regulatory liability whose existence is uncertain, if it is more likely than not that the asset or liability exists. In contrast, the IASB also agreed not to set a recognition threshold based on the level of measurement uncertainty. An exception is regulatory assets and regulatory liabilities, whose measurement depends on benchmarks that are known only after a company's financial statements are authorized for issue. The IASB specified that those regulatory assets or regulatory liabilities should be recognized when those benchmarks are known. As I mentioned earlier, the other aspect of recognition we touched on was its interaction with the assessment of enforceability. As background, the proposed definitions of regulatory asset and regulatory liability in our exposure draft include the term enforceable present right or enforceable present obligation. We heard from our stakeholders that assessing whether enforceable rights and enforceable obligations exist could be very challenging in some circumstances. Taking into account this feedback, the IASB decided to retain the proposed single assessment of the existence of enforceable present rights and enforceable present obligations at the level of the individual regulatory asset or regulatory liability. Alongside this, the IASB also decided to enhance the proposed requirements relating to the assessment of the existence of enforceable present rights and enforceable present obligations. This includes incorporating specific principles from our revenue standard, IFRS 15, in the requirements relating to regulatory returns on an asset not yet available for use and long-term performance incentives.
Thank you, Andreas. Why don't we turn next to the IASB's discussion on performance incentives in this rate-regulated activities project. Linda, could you chat through the IASB discussed this month?
Sure, Nili, let's do that. This month, the IASB's discussion focused on the proposed accounting for performance incentive, except for those that test a company's performance over several periods, or what we sometimes call long-term performance incentives. As Nili mentioned earlier, we will discuss the accounting for long-term performance incentives at a future meeting. The IASB agreed to retain its proposal relating to performance incentives. The proposal requires that amounts relating to performance incentives, including those that test only a company's performance of construction work, should form part of or reduce the total allowed compensation for goods or services supplied in the period in which the company's performance gives rise to the incentive.
Thanks, Linda. We'll have plenty to look forward to as the IASB continues its discussions on this project. And moving on to the third of our 4 standard-setting projects that the IASB discussed this month, business combinations, disclosures, goodwill, and impairment. Unlike the rate-regulated activities project, the IASB is still working towards developing an exposure draft to consult with stakeholders. This month, the IASB discussed how these proposals could work in practice. In particular, the IASB discussed the management approach to disclosing information about the subsequent performance of business combinations. Andreas, can I turn to you to update us on the IASB's discussions?
Sure, Nili. In the past, the IASB has tentatively decided that a company would be required to disclose information about the subsequent performance of business combinations applying a management approach. The management approach here means the information a company would be required to disclose is the information the company's management uses in assessing the subsequent performance of business combinations. This month, the IASB discussed exactly how that management approach would work. This includes revisiting the IASB's preliminary view in the discussion paper that relied specifically on using the role of a company's chief operating decision maker in identifying information a company would be required to disclose about the subsequent performance of a business combination. After what I consider to be an insightful discussion, the IASB voted in favor of specifying key management personnel, as defined in our related party disclosure standard IAS 24, as the level of management within the company to identify the information the company is required to disclose about the subsequent performance of business combinations. So that constitutes a change. In making this change, the IASB is responding to concerns from stakeholders responding to the discussion paper that using a company's chief operating decision maker would not identify the most useful information to include in financial statements.
Thanks, Andreas. There were other aspects of the management approach discussed by the IASB. Linda, could you share with us some of these other tentative decisions?
Certainly my pleasure, Nili. The IASB also discussed aspects of the management approach, such as how long information should be required to be disclosed. On this topic, the IASB decided to maintain its preliminary view. That is, to require a company to disclose information about the subsequent performance of a business combination for as long as a company's management continues to monitor whether the objectives of the business combination are being met. In the event a company does not monitor or stops monitoring whether its objectives for a business combination are being met, the company should disclose that fact and the reasons behind it. The IASB also tentatively decided to add a requirement to disclose some information in the first 2 years after a business combination, even if management stops reviewing it in that time. This amendment to the preliminary reviews is intended to respond to feedback about how some companies monitor the performance of their business combinations.
Thanks, Linda. So I think the takeaway really for this project is that in February, the board continued to build out the details of its disclosure requirements. And as a next step, the IASB will be further building out some aspects of the disclosure requirements and then exploring some possible changes to the impairment test in IAS 36. So this month, the IASB also discussed dynamic risk management, or DRM for short. Just to remind our listeners, the IASB is developing a dynamic risk management model with the objective to better reflect a company's interest rate risk management strategy and activities in its financial statements. Andreas, could you summarize the IASB's discussions on this project?
You'd be delighted to. One of my favorite projects. Our discussion focused on two matters that are items eligible for designation in the current net open risk position and performance assessment of the DRM model. Before we dive further, I think it would be helpful to remind our listeners what we mean by current net open risk position. We introduced this concept back in November 2021 as the net open interest rate risk exposure by time bucket derived from the combination of a company's assets and liabilities, including core demand deposits and eligible future transactions over the period the company is managing such risk. This month, the IASB discussed what items would be eligible for designation in the current net open risk position. The IASB tentatively decided that financial assets measured at fair value through other comprehensive income, or OCI, are eligible for designation in the DRM model, but financial assets measured at fair value through profit or loss are not. And this is because financial assets measured at fair value through OCI have the same exposure to variability in future net interest income and fair value as financial assets that are measured at amortized cost. The IASB also discussed the performance assessment of the DRM model this month. More specifically, we looked at whether it is necessary to refine the requirements for the assessment of the performance of the DRM model. In this regard, the IASB's tentative decision was not to require companies to make a retrospective assessment against its target profile, and rather to require companies to assess whether the current net open risk position at the end of the DRM assessment period can realize the expected benefits represented by the DRM adjustment.
Thank you, Andreas and Linda. That brings us to the end of our podcast. But before we wrap up, I wanted to remind our listeners that the comment period for 2 of our consultations are coming to an end soon. If you have yet to share your feedback with the IASB on either the exposure draft on the IFRS for SMEs accounting standard, or the exposure draft on the international tax reform proposals related to amendments to IAS 12, please do so as the comment period is coming to an end within the next week to 10 days. That is all for this month's podcast. As a reminder, you can catch up on previous episodes of this and the IFRS Interpretations Committee on our website, as well as our YouTube channel and Spotify. For the latest developments, make sure to subscribe on our website. If you like this podcast, please do take some time to rate, review, and subscribe on your preferred podcast player. Thank you, and see you next month.